Carroll, lead partner at A.T. Kearney and in New York, David Kirkpatrick, CEO of Techonomy and our Bloomberg contributing editor, as well as Lucas Shaw, our Bloomberg News reporter who covers Netflix. Greg, I want to start with you because this is a stock that has been extremely volatile. In fact, when he got off the call at the end of last quarter, Reed Hastings apologized for the volatility. So today we're seeing the kind of volatility you want to see, but still it's unexpected. What's your take on the good and the bad in today's results?
Well, there's probably two key drivers of that. One is it's a stock that everyone loves to watch. So there's no shortage of opinions that are going to move it one way or the other.
It's certainly entertaining.
It's very entertaining. And then the second part of it is, and you can see by the subscriber jump, it's very tough to predict how subscribers are going to react to the offers that Netflix is putting out there. So not only do you have kind of the entertainment portion of the stock, but you're also dealing with unproven response models for why consumers subscribe or why they don't.
Lucas, what stands out here to you? A couple of things that were also mentioned, a few weeks ago, Reed Hastings says prospects in China don't look good. Today, they announced that they're going to be licensing some of their content to streaming providers in China. How big a deal is that?
It could be a very big deal if they, depending on kind of how much they get in return. I think investors had already baked into the stock the fact that Netflix probably wasn't going to go there. So the opportunity to sell to partners is, in a sense, a concession, them saying that they're probably not going to get there anytime soon, if at all. At the same time, I think a lot of people have been wondering at what point Netflix would start licensing some of its shows back to other people, and whether it works in China could kind of portend some of that elsewhere as well.
They're also talking about an increasing amount that they'll be spending on original content, which now accounts for 10 to 20% of content costs altogether. That could go up to 50%. David, obviously, in many respects, the original content is what has retained subscribers and gotten new subscribers. But, at what point does this just get too expensive?
Well, if I were an investor, it's already too expensive. I mean, the 300 plus PE, the problem is, in my mind, look, I love Netflix as a company. I think they've done great things. I'm somebody who sends them money every month, but along with 80-some million other people. But the fact is, it's a really, really good media company that happens to distribute its content over the internet. I don't believe it's a go-to-the-moon company. I think it is a very fortunate company that has grouped itself among the internet community. Therefore, it's perceived to have value alongside companies that really it isn't that much like.
How do you respond to that, Greg?
The question is going to be how they spend the money. If they just wildly throw money into the market and in a quest to just generate hours, the whole model will fall apart, because we don't need more clutter in a video environment.
Does it seem as if that's what they've been doing?
Well, that's the risk. They haven't shown themselves to do that yet. They seem to be very prudent in how they're building it out. But if it becomes a quest for hours rather than a quest for high-quality programming, then you could start to see some trouble on the horizon.
Lucas, part of the volatility has been driven by this idea, reports that Netflix could be an acquisition target. What is the very latest that we know?
Nobody seems to think Netflix is getting acquired by anyone. I mean, Reed Hastings is an entrepreneur by training. He's not someone who seems to want to sell his company. If you listen to him talk, I mean, you asked earlier what stands out. He believes that we are at the beginning of this great migration of television to the internet, and that, you listen to the companies that he looks up to, it's not Disney, it's not CBS, it's not these media companies, it's tech companies like Facebook, like Google, who have massive customer bases, and that's what he sees as the potential for Netflix. Now, there's no guaranteeing that he's going to get there, but they're at almost 90 million customers now. He wants them to be in the hundreds of millions within the next several years.
David, the vision is big. Does that bring you any more confidence?
Well, I was talking to Lucas about it before the show started. I actually would say no, but here's the way they could change that opinion on my part. If they actually started adding other services and became more than just basically a really good video delivery service, and with the kind of numbers they have and with that scale of a vision, I wouldn't rule out that they might think of other things they could do for people like me and probably everyone else on this program right now who pays the money every month.
Greg, you get the last word here.
Well, there's no doubt they're going to have to figure out a way to not only use the data they have better in order to monetize the content, but as they mature as a business, the true business elements are going to come into play as well, as it relates to how do they manage costs, how do they invest wisely, how do they build out a profitable, growing business, not just a startup that happens to be public.
All right. Greg Portal of A.T. Kearney, lead partner there. David Kirkpatrick, our Bloomberg contributing editor. You're sticking with me. Lucas Shaw, who covers Netflix for Bloomberg News. Lucas, thank you as well. Also out after the bell, IBM beating analyst estimates for the third quarter, reporting $19.2 billion in revenue and earnings per share of $3.29. CEO Ginny Rometty highlighting that IBM is seeing double-digit growth in its strategic imperatives. In other words, the revenue coming from artificial intelligence, data analytics, cloud computing, and security. Joining me now, IDC Chief Research Officer Crawford Del Prete and our guest host, Techonomy CEO David Kirkpatrick, still with me. So Crawford, I'll start with you. It's a beat, but still the 18th quarter of revenue declines. Tell us the good and the bad here.
Yeah, you got to give this company credit. This company has been on a long-term, multi-year transformation, and we are now seeing really good progress of that. Sure, would people have liked to have seen a little more revenue growth? Absolutely. Margins also took a hit. However, 40% of the company's revenue is now associated with these strategic imperatives. They are showing sustained growth in these strategic imperatives. And this is a company that, it was not that many years ago, an army of people innovating and marching in one direction. Now they're starting to move in another direction, and they're making progress. You can really see that in the numbers. And I think when you really see the progress that they're making in cognitive, in the cloud, and again, in these strategic imperatives, particularly a sustained 15% growth. So, you take that back. They've been close to the teens or in the teens now for a number of quarters in that business off very meaningful revenue. In a nutshell, that's progress. And, they deserve to be commended for that.
IBM, Crawford, is staking its future on Watson. At what point do you think we'll start to see Watson generating significant revenue?
I think on an individual project basis, you're starting to see the seeds of that now. When you look at what we call the innovation accelerators, which are things like the Internet of Things, next generation security, robotics, cognitive solutions, 3D printing. If you look at all those areas, the one area that you can pull through all those is cognitive. So cognitive is a bet on invention that IBM has made, and that will drive significant value in the future. So for example, when you look at companies' journey toward digital transformation between now and 2020, the only area that really increases, and we see it increasing by 4 percentage points in terms of, 6 percentage points in terms of how much people will invest, is in information management. That will be driven by cognitive solutions, because people just can't help you get those answers. You need cognitive solutions. So we will see that really start to accelerate in the 2018, 2019 timeframe. But we're already seeing the seeds of that in some of their engagements today.
David, you've spent time with IBM CEO Ginny Rometty. How confident are you that this strategy is the right strategy? They're putting an awful lot of chips in this AI Watson basket. Is it going to pay off?
Well, like Crawford, I admire these people. I mean, I've been covering IBM for over 25 years, and the fact is, they have made some really big bets in some areas that took a lot of kind of guts to do, and I'm impressed at the growth they're getting out of those areas. And I was just sitting there thinking, what if IBM got a valuation just for those growth areas that was comparable to the kind of valuation Netflix is getting for its business? They would probably be able to not even count the incredible revenues and profits they still get from those declining other businesses in their portfolio, like mainframes and all the old style, relatively unsexy software that they've had for years. They've always been a portfolio business. They're managing the portfolio pretty well, but it's hard to run a big portfolio. I'm impressed.
Crawford, IBM saying on the call they're going to continue to invest in acquisitions. They've already made 12 acquisitions so far this year. What impact are acquisitions having on revenue growth?
Well, they're absolutely having an impact. Look at it in terms of strategic imperatives. I mean, if you look at their acquisition of a company, so for starters, if you look at the cloud, their acquisition in the cloud really is what gave them the basis for them to start growing that business, 3 or 4 years ago. Now, go a little bit more near term, their acquisition of the weather company it was a significant acquisition, and it did a few things. It gave them a platform to start building out and attracting developers toward weather data, which is one of these ubiquitous kinds of data sets. But it also gave them skills around building that into cognitive solutions that they didn't otherwise have. So I think when you look at IBM and acquisitions, look to the industries, look to vertical segments, understanding purchase behavior, understanding how people, what data sets are really scarce in different industries, like logistics, like transportation, like healthcare. That is likely where IBM will go.
Last quick question, Crawford. When will we be reporting the first quarter of revenue increases?
Well, that has to do a lot with a lot of things, currency fluctuations. But I think it really spins on the financial services business and the systems business at IBM. And unfortunately, like we've seen with a lot of other tech suppliers, those systems businesses can decline for a long time because they're really, really big. I do think we should be getting close to that in the next 4 quarters. Again, as IBM continues to balance this portfolio. But I think the real thing you want to focus on right now is the progress that they've made.
All right, Crawford Del Prete of IDC. Crawford, as always, thanks so much. David Kirkpatrick, our Bloomberg contributing editor, you're sticking with me. Up next, Apple's top secret plan to take on Detroit is a shadow of what it once was. We'll bring you up to speed on how much Project Titan has evolved in just 2 years. And a reminder that all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out at Bloomberg Tech, weekdays at 6 p.m. in New York, at 3 p.m. in San Francisco. This is Bloomberg. To tech's revolving door, Apple has a new head of artificial intelligence research, Russ Salarkudinov, the prominent AI expert from Carnegie Mellon University. While Apple was an early player in machine learning with its voice assistant Siri, it's now locked in a race to catch up to competitors like Google, Microsoft, and Amazon. This key hire follows as many as half a dozen startup acquisitions by Apple in the field of artificial intelligence in the last 12 months. Staying with hiring and firing at Apple, it's been 2 years since the company launched its top secret Project Titan. This is the internal name for the group working on an Apple-designed car targeted for unveiling by the early 2020s. The goal was to upend an industry that McKinsey estimated would be worth $6.7 trillion by 2030. But since then, Apple scaled back its plans dramatically. Our Bloomberg Tech reporter Mark Gurman with me here in the studio. Also still with us, Techonomy CEO David Kirkpatrick. So, Mark, we've reported on changes with Project Titan before, but never in so much detail as you have now. Tell us what the new details are and what went wrong.
Sure. Well, our story really gives the first inside look about what's going on at Apple in terms of this car project. Back in 2014, Tim Cook, the CEO of Apple, tapped a man named Steve Zadesky, a former Ford engineer who worked on many iPhones and iPods, to hire over 1,000 people to work on a full-fledged vehicle to take on Detroit, as well as Tesla. Now we're hearing that Apple has lost hundreds of employees on the project and is now focusing on a self-driving platform that could underpin any car.
So have they lost those employees? Have they left? Have they been fired? I mean, is this part of a new strategic direction for the company?
Right. There's three things going on here. There's three ways that they've lost these several hundred employees. The first is people leaving by their own will because they don't believe that an Apple car will ever ship. They don't like the direction of the program. The second reason are people being reassigned to other parts of Apple, working on other products. So technically they're off the team, working on iPhones, iPads, Maps, whatever. And then there's people who were actually laid off. Over 120 people we reported in the software engineering part of the car project working on a car operating system were laid off in waves happening in both August and September of this year.
So what is Apple currently trying to do?
Right
Just
now,
the platform, is that, so no car?
well,
No full-fledged car?
Exactly. They got rid of hundreds of people, or hundreds of people actually, we should say, left on the hardware side, people working on car suspensions, mechanics, battery charging components, stuff like that, undercarriages that would normally be in a car. Instead, they're focusing on this underlying self-driving system. Now, the thing with this is they can go back to the drawing board in a year or two from now and then decide what to do with it. It would be attachable to an Apple-designed car if they so choose to go back to the drawing board on that. They could sell it to a car maker. They could buy a car maker. They could partner with one. We talked about on an earlier show how they were looking at partnering up with McLaren for a financial investment. So that's another route they could take. But it just seems like they're not deciding yet what they're going to do. And in our report, a couple paragraphs in, we talk about how Apple set a new milestone date for next fall. Next fall, they're going to decide what they're going to do.
Interesting. David, what do you make of the twists and turns with Project Titan?
Well, first of all, I got to say, what a privilege and treat it is to be on Bloomberg Tech with Mark, because you guys have got the reporter par excellence on this kind of stuff now.
Absolutely.
I mean, I'm learning so much. I don't think it ever made sense for them to build a car, in my own opinion. I have to say, I'd love to hear Mark's opinion on that, but let me just blurt out a few other thoughts before we hear that, hopefully. Honestly, you know, the time it takes to do that is so long, and it's so outside of their core competence, regardless of how much money they have, that I was always skeptical of the idea of building an Apple car. There are huge perils in that. The idea of doubling down on software, which is what they really are good at, makes a lot of sense to me. But what I'm curious about, and maybe Mark could talk about it, is this in effect just a kind of grandiose extension of the CarPlay strategy to include self-driving features?
Mark?
Absolutely. Well, to your first point, I agree completely that building a car is a difficult endeavor. It's something that they plan to take almost 10 years to do, starting in 2014, shipping in the first half of the 2020s. But they realized that they just did not have the engineering expertise. They didn't have the politics. They didn't have the culture to build a car. What happened was they basically set up a whole different ecosystem of employees and partners to build this car in the city of Sunnyvale, California, a few miles out from their main Cupertino headquarters. So they basically built up a whole separate unit, a mini company with over 1,000 employees to build this car, mashing people together from Tesla, other car makers, and even Apple engineers working on other products. So it's basically mashing a bunch of people together to work on this car under the leadership that delivered iPads, Macs, and iPhones. But we're talking about a car here. The amount of components and technology expertise that goes into an iPad is 1/50th, 1/100th of a car.
So would you say this is just a grand extension of CarPlay as it stands now?
What they're looking at now is I would say more than a grand extension of CarPlay, maybe a very, very grand extension of CarPlay, because building these self-driving platforms requires a lot of expertise in the camera field, in the sensor field. So it's a lot more, and they would probably want to do their own operating system and low-level software on that too.
All right, Mark Gurman, keeping Apple and us on our toes. Thank you so much, Mark Gurman, our Apple Bloomberg Technology reporter. David Kirkpatrick, you are sticking with me.
I learn a lot.
Later this hour, we're going to pick up the conversation with Goldman Sachs analyst Simona Jankowski. She will be talking about Apple's next big hit, what she thinks could be a subscription service like Amazon Prime. And a programming note, a new special is coming to Bloomberg TV in prime time, The David Rubenstein Show, peer-to-peer conversations. The renowned financier and philanthropist travels the country talking to leaders to uncover their stories and path to success. The first episode features Microsoft co-founder Bill Gates.
So what did your family think? Did they say there's something wrong with this young man? He wants to just do computers?
They knew I was obsessed with computers, that I would skip athletics, that I'd go in overnight, that I'd leave the house sometimes when they prefer I wouldn't go work at night on these things. And so it was kind of considered a little strange.
The show explores successful leadership through the personal and professional choices of the most influential people in business. This 6-part series debuts 8 p.m. Eastern. More of Bloomberg Tech next. A stock we are watching, Take-Two Interactive. Shares of the game maker surged nearly 7% at one point in Monday trade after its Rockstar Games account tweeted this picture. There's no title or text, but fans and industry observers suspect it is a teaser image for the highly anticipated Red Dead Redemption sequel. Take-Two has sold 14 million copies of Red Dead since 2010. And while that's small, compared with Grand Theft Auto's 245 million lifetime sales, analysts suggest a franchise revival, along with other titles, may help drive Take-Two back to growth after a flat 2017. Coming up, Tesla CEO Elon Musk pushed back a highly anticipated product event scheduled for Monday. Now you have to wait till Wednesday. More on the change of plans next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg.
I'm Nina Melendez, and you're watching Bloomberg Technology. Let's begin with your first word news. At least 20 people were killed after a fire broke out in a hospital in eastern India. Local officials say the blaze started in the dialysis ward. Police and firefighters worked with hospital staff and volunteers in a rescue operation to evacuate more than 500 patients. Germany is joining the U.S. and the UK in considering new economic sanctions against Syria and Russia over attacks on the city of Aleppo. U.S. Secretary of State John Kerry and his British counterpart Boris Johnson have all but ruled out a military response to end Aleppo's siege. 2 people were killed and at least 6 others injured in an explosion at a facility belonging to chemical firm BASF in southwestern Germany. Another 2 people are missing. The blast occurred at a river harbor used to unload flammable liquids and liquefied gas. And in the U.S., Melania Trump is dismissing a recording of husband Donald Trump making degrading and lewd comments about women. She says the aggressive language is, quote, boy talk and does not reflect the man she knows. In a series of interviews, Trump's wife said she has accepted her husband's apology and the couple is, quote, moving on. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Nina Melendez. This is Bloomberg. It's just after 6:30 p.m. Monday here in New York, 9:30 a.m. Tuesday morning in Sydney. I'm joined by Bloomberg's Paul Allen with a look at the markets. Paul, good morning.
Good morning, Nina. It doesn't look like it's going to be the greatest of days across the Asia-Pacific on the markets. The NZX been trading for just over 90 minutes now and is already off 0.75%. The Nikkei's look like it's going to have some declines as well, while the ASX here in Australia is expected to open flat in just under 30 minutes' time. Keep an eye on Crown Resorts today. The gaming stock suffering its worst loss on record yesterday. $1 billion in value wiped out, and it took down other gaming stocks with it around the world. This is after 18 employees were detained in China on suspicion of, quote, illegal gambling activities. Exactly what the detentions happened for is still an open question, but the Australian government is offering consular support to those employees, and the billionaire owner of Crown Resorts, James Packer, has put out a statement this morning saying he's deeply concerned and the number one priority is to make contact with those employees and ensure their safety. So keep an eye on Crown today. Keep an eye also on the Aussie dollar, been showing some strength recently against a weakening greenback. The Reserve Bank releases minutes of its October meeting in a couple of hours' time, so that could move the local unit here. I'm Paul Allen in Sydney. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Emily Chang. It's time to greet the week and dive into the tech stories that are front and center in the days ahead. First up is Tesla. The electric car maker has pushed back its product event from Monday to Wednesday. It is the first of a slew of events for the automaker in coming weeks. We also want to set up a number of major tech companies due to report earnings this week. Joining us now to discuss Bloomberg Views, Ed Niedermeyer from Portland, and Bloomberg Gadfly Shira Ovide with us from New York, as well as my guest host for the hour, David Kirkpatrick of Techonomy. So, Ed, I want to start with you and Elon Musk tweeting, moving the Tesla announcement to Wednesday, need a few more days of refinement. What do you make of this change? Not particularly unusual, but certainly not what you want to hear.
Yeah, well, it certainly doesn't seem to have done the stock value any favors in the short term. And I think, there's been a lot of speculation. No one has really known what this product announcement was going to be. So there's sort of some questions now about, well, if it just needs a few more refinements, clearly that points to something that could be hitting the market soon. I think that indicates something more along the lines of a feature for Model S and Model X, the vehicles that are already on the market, rather than some more longer-term product launch. So Autopilot has been at the top of the list of speculation for this product launch. It's possible that with news coming out of Germany and elsewhere about issues surrounding the use of the word autopilot, that could be a factor here. But honestly, it's so wide open with Tesla that we can only speculate at this point.
So walk us through the possibilities. As you mentioned, autopilot, it could be, others have speculated it could be a look at the Model 3 or the Model Y, that it could have something to do with the merger of Tesla and Solar City. Which of these scenarios do you think is most likely and why?
I would say something to do with autopilot is high in likelihood. I would say one of the other things that people, I think, makes sense to be sort of high on the list of things to look for is something to do with their vision system. They, as part of this sort of breakup with Mobileye that they've had, there's been a lot of talk around an in-house sort of camera system and potentially even a glass system, sort of like a heads-up display of some kind. So those I think are the most likely, and especially because the heads-up display is something that was talked about with the Model 3, and yet Tesla says its Model S and Model X are sort of the technology leaders. It makes sense that a feature that will eventually end up in Model 3 may be getting pushed to the Model S and the Model X now. There was also a slight slowdown in production recently that could indicate toward new hardware being put into the vehicles. Other possibilities include potentially an inverter to make the bridge the gap between SolarCity's products and Tesla's stationary storage, things like that. Again, because of this delay, it indicates something that will be going to market soon. So I would look for probably a heads-up display would be my top guess, and then an autopilot update, hardware update would be my second guess.
All right, moving on to Yahoo. We're expecting Yahoo to report earnings on Tuesday. There's a lot going on here. Shira, Yahoo says they're not doing their traditional webcast that they have been doing around earnings calls, citing the pending Verizon acquisition. We've talked a lot about how that acquisition, or at least the price of it, could be in jeopardy, though analysts have told us they still expect it will go through. What do you make of this move not to have the traditional call?
It's not so unusual. I mean, most companies that have an agreement to be acquired, they do perfunctory earnings calls, if any at all, where basically they say nothing about the current state of affairs. Obviously, the big question is, even in a canned statement from the CEO or CFO, will they address this question of, does the Verizon acquisition deal need to be recut or repriced because of this disclosure issue about the hacking?
And then Microsoft coming up this week as well. What stands out to you there? We've, of course, been talking about Microsoft's, growing ambitions and progress in the cloud, certainly relevant considering what we've been seeing from IBM today. What will you be watching?
I mean, the big question for Microsoft, as always, is the cloud business. Office 365, the cloud version of their Office productivity bundle, plus Azure, the competitor to Amazon Web Services. It's really been remarkable under CEO Satya Nadella the last few years, to see the investor sentiment completely change on the company. This was a company that could do almost nothing right in the technology sector 3 or 4 years ago, and now they're a company that is considered kind of a forerunner, and you can see that in the stock market value.
It's a big week, David, kicking off earnings first of all, an announcement coming from Tesla. What are you watching most closely this week?
Well, you've gotten me really excited about this Tesla announcement, although I still have been spending a lot of time thinking about the way that Elon Musk talked about climate change when he announced the Model 3 in the spring, because to me that was a really big vision. And I think this interesting controversy over autopilot and Mobileye pulling out, that's a surprising thing. A company walking away from a good customer like Tesla because they didn't agree with the way they talked about the usage of the technology, using the term autopilot, et cetera, which I do think is a misleading term and really is unfortunate. But I love Elon Musk's big picture vision about thinking about climate change at the core of everything that company does. It would be great, in my opinion, if that was something he talked about tomorrow.
All right. Well, we'll be covering it all. Tesla, Yahoo, Microsoft coming up this week. David Kirkpatrick, our guest host, you're sticking with me. Bloomberg Views, Ed Niedermeyer. Bloomberg Gadfly's Shira Ovide. Thank you both. Still to come, could Apple's next killer project look something like Amazon Prime? We'll hear from the Goldman Sachs analyst who thinks a subscription plan would be a good idea. This is Bloomberg. Apple's next big hit may not be hardware, but it could be a service that works a lot like Amazon Prime. A team of analysts at Goldman Sachs suggests that a subscription service could be the key to boosting iPhone sales as Apple's flagship product becomes a less dependable source of growth. The hypothetical plan would cost $50 a month and would rely heavily on streaming services from Apple TV and Apple Music. Senior research analyst Simona Jankowski wrote the note from Goldman, joins me now here in the studio with more details. David Kirkpatrick, our guest host, still with us. So, Simona, it's certainly an intriguing idea. What exactly would be in this subscription package?
Sure, and thanks for having me, Emily. So the basic idea here is that Apple really should look for ways to transition to more subscription services. And that's because the smartphone industry at this point is basically an ex-growth industry. And so we're really looking for what is next around the corner. Now, as we thought about this, we thought that the key for Apple would be to construct a subscription bundle. And so here, both the element of subscription and the element of bundle are pretty critical for this idea. And that's really quite similar to what Amazon Prime is doing in terms of bundling a few products and services into their Amazon Prime offering. In the case of Apple, and we did use the same moniker, Apple Prime, just for convenience, it would be a fairly similar set of products and services that you could consume as part of the bundle as what you might otherwise buy today on an a la carte basis. So for example, for $50 a month, a consumer would get the iPhone, which today you can get a la carte for about $32 per month. Also included in that bundle would be the Apple TV, which would be effectively subsidized by Apple, but from a consumer perspective, they would get that up front. And then included in that would be Apple Music, which today you can get for about $10 per month, as well as Apple content, things like TV shows and movies that today a lot of consumers get from Netflix or Amazon.
You'd still have to pay for the content on top of this, though, right?
So it would be a similar model to what Amazon does in that it's a freemium model. So some shows you can pay for, so $1.99 or 99 cents. Some of them, though, are subsidized in this model, again, similar to what Amazon does, so that the consumer, it looks like, included with Prime.
David, it's interesting. How likely do you think it is that Apple would ever do this?
Well, I think it's a very creative idea. I think a lot of people would be interested in it. And one thing that, when Simona describes it, impresses me is the concept that it could allow Apple to sort of seed the market with new products that otherwise might not be catching the excitement of the crowd and get critical mass a lot more rapidly. So that I like. The thing I wonder about is whether this is the time to be thinking about such a thing when their primary competitor, Samsung, is kind of self-destructing before our eyes. So they don't really need a major shift, in my view. So that's my question. And I guess I'd be curious to ask Simona whether really she thinks this is something they would seriously consider.
Sure, David. So I think you make a good point there in terms of the iPhone 7 actually being a pretty good product cycle as it is. And in fact, we are very positive on the shares right now, and that is primarily because we expect that there is going to be a pretty decent upside both for this quarter and for next quarter in terms of the actual units. And that's in no small part due to the fact that their main competitor, Samsung, has had the issues you just talked about in terms of the Note 7. However, the point that we wanted to look at here is just really looking beyond this next product cycle. Because if you zoom out for a second and just look at the industry as a whole, there's really not a lot of growth left in the smartphone industry. We're looking at low single-digit growth in the long term. And so looking at Apple's long-term prospects here, we really need to look at some of these adjacent revenue sources.
So scale of 1 to 10, how likely do you think it is that Apple actually does this, and when?
So, we want to emphasize that this is really an illustration, and we don't necessarily expect them to do the exact thing that our report is talking about. But just in the last year alone, they have come out with Music, Apple Music, which is, as they called it 2 quarters ago, their first subscription service. And so the fact that Apple is calling that their first subscription service leads me to believe that there may be a second, and I think this one would make a lot of sense.
David, it's interesting. I mean, how do you think something like this would compare to Amazon Prime, since Apple certainly doesn't have an equivalent?
It would be 6 times more expensive, which is a problem. But I do think that Simona is really right that they need more subscriptions. They've signaled they want more subscriptions. So I think it's a very promising kind of avenue of inquiry. I don't think anything exactly like this is probably going to happen, but I bet they take what Goldman Sachs says seriously, so I'm sure they're thinking about it. I'm sure they were already thinking about it, but I'm intrigued by the notion.
And last question, Simona. I mean, Apple is starting to explore original content. They're working on a series, Planet of the Apps. Of course, this is something that Netflix and Amazon have, dived head into because they believe that original content will be the secret to keeping subscribers and getting new subscribers. Would that have to be an important part of Apple's strategy?
Sure. So I do think that original content is going to be a pretty significant part. It's really not the most important part, though, at this point in time. And the reason I say that is we actually ran a survey of 1,000 U.S. consumers asking them whether they consume their TVs and movies from iTunes or from other services like Netflix and Amazon. And interestingly, the majority were consuming them from services like Netflix and Amazon. And the reason they cited was because of the subscription element of that, or the all-you-can-eat element of that, not original content. There was only about 2% of the respondents who pointed to original content. So we think the first priority here would be for Apple to launch the subscription service, and that could buy them time to add original content over time.
All right, Simona Jankowski of Goldman Sachs will be watching. You've certainly gotten us talking. Thank you so much for joining us. David Kirkpatrick, you're sticking with me. Up next, China blasts ahead with an ambitious plan to catch up to the U.S. and Russia in the space race. Details of the progress next. This is Bloomberg. In this edition of Out of This World, China has sent 2 astronauts into space for the country's longest mission yet. The crew will spend just over a month in space, with most of that time aboard an orbiting laboratory. China has spent billions over the last decade to catch up in a space race led by the U.S. and Russia. It's aiming to operate its own space station by 2022, send an astronaut to the moon by 2025, and land an unmanned vehicle on Mars. Turning back to the biggest mover in tech and extended trading, Netflix shares continuing to pop on better than expected subscriber growth. Despite its 12% retreat this year, Netflix remains one of the priciest stocks in the NASDAQ 100. Netflix is currently valued at 313 times earnings. Still with me, David Kirkpatrick, CEO of Techonomy, and with me on set, Corey Johnson, our editor-at-large. We were talking about it's bow tie day. David, apparently, David has inaugurated bow tie day on Bloomberg Tech.
I'm going to a formal event. What can I say?
Once again, he's showing me up.
Somebody is dressed fancier than you, Corey. So, first of all, it's, we talked about the volatility earlier, the stock up, and this is the kind of volatility investors like to see. But again, it's just been a zigzag for this.
If you're short, you don't like it. Netflix is a stock that reacts violently to corporate earnings reports because the company doesn't always meet those results. Last quarter, they came out and missed all their major metrics except for EPS. They were able to miss on on international growth, domestic subscriber growth as well. This quarter, however, the subscriber numbers looked very strong. Now, I will note that it's in tandem with raising its marketing costs as a percentage of revenue. You spend more money on marketing, you get more customers. That's the way any business works. But nonetheless, these are positive numbers from Netflix showing growth internationally and domestically.
Talk to us about what's going on in the U.S. market versus what's happening globally.
So what we're seeing in the U.S. is that's the developed market. So Netflix investors, bulls and bears alike, like to say the U.S. looks one way. That's what the developed markets might look like for Netflix. International markets look different. So the U.S. market we saw is very, very anemic growth in terms of subscriber count. So Netflix might be as big today as it's going to get in the U.S. Just the growth numbers are just not there. Of course, they're facing really strong competition from Hulu, from HBO, from Showtime, and certainly from Amazon Prime, and that may reflect that.
David, more closing thoughts from you as we wind down the show. The share's still up, but certainly a lot of questions, just how much they're spending on content, whether or not they are an acquisition or not, whether they can break into China, sort of what is the prevailing thinking around Netflix and its future right now?
Well, the way I would look at it is, if you're somebody who thinks Netflix is worth buying at this kind of a price, you should look more closely at buying Disney, which is a way cheaper stock and has equal, if not much greater, actually, probably significantly greater capacity, proven capacity to build high-quality content. And it actually makes me wonder again about something we were talking about in the show last week. Should Disney buy Twitter? If Twitter went down enough in price, maybe they should, because then they could have a distribution vehicle on top of their content creation capabilities. I still think the way to think of Netflix is just a really, really effective media company that has an internet valuation, and I'm not sure that makes sense.
Corey?
Well, there's no free cash flow. I mean, at the pace in the quarter reported today, Netflix will burn through $2 billion this year. So it doesn't look like media companies are all about free cash flow. Now, they, of course, say they're investing for growth. But as I mentioned, those U.S. subscriber additions are very low. The international numbers look good. Then they've got this off-balance sheet problem where they've got $14.4 billion in content that they've contractually guaranteed minimums to pay, that they've got to generate the cash flow to do that. So when you see the cash flow flowing out, that's because they're paying so much for content in a competitive environment against HBO, against Amazon Prime.
What about these numbers concern you most?
This one. I mean, this number of $14.4 billion that's not on the balance sheet, but is a contractual commitment this company has that they have to pay out that minimum amount of money. They're going to have to bring in a lot of money from subscribers. They've got to keep those subscribers in the fold. They've got to bring down their costs in marketing and content, which they've been unable to do. So Wall Street loves the stock right now. They may. But there are some concerns on the horizon when it comes to paying for all this content.
David, you are shaking your head.
Well, I'd just love to ask Corey, I mean, don't you think the PE compared to traditional media companies, you just gave another argument why somebody who cares about media and content should be looking elsewhere, in my opinion.
Yeah, well, absolutely. Look, fundamentally, a business has to make money, right? You sell something for more than it costs, and you keep some money when you're done. That applies to all of business, and it's going to apply to Netflix eventually. Right. Now, we've had this perverse example in the public markets in the last 15 years of Amazon.com, but Amazon.com has reinvested all of its free cash flow into the business. It has not been free cash flow negative. It has also not gone back to the public markets to sell more equity, unlike so many of these other companies that want to emulate Amazon.com.
What about China? I mean, obviously, sort of the way they intended and hoped to get into China is not really working, but now they're talking about licensing their content to Chinese streaming providers. Other U.S. technology companies haven't had a lot of success in China, but media companies like Disney have.
They have in certain ways, and you're right, they've brought a different model to China, whether it's in Disney's case in a theme park or with content. One of the things you saw the focus in both the press release and the conference call today was Netflix talking about owning the content that they make. So unlike, for example, the most famous case of House of Cards, they don't own that content. They license that content for a limited period of time, then it goes back to the creators. Netflix is talking about owning their content in a very Disney-like way to own this stuff for a while. I got to ask, what's your favorite Netflix show right now?
My favorite, Narcos.
So
Love it.
They talked about Narcos.
I can't watch Stranger Things because I don't like scary. But
you don't know
Narcos,
more. You used to.
It's actually a different kind of scary, but I like it.
Get Down. Get Down with Get Down. It is so good.
All right, I'll check it out.
Diane and I have been watching this.
Always looking for something good. Corey Johnson, our editor-at-large, David Kirkpatrick, CEO of Techonomy, and our guest host for the hour. David, thank you so much for joining us today. And that does it for this edition of Bloomberg Tech. Tomorrow, we've got an exclusive conversation with Zenefit CEO David Sachs, plus Lyft co-founder John Zimmer will be joining us. Remember, tweet your questions. We're at Bloomberg Tech TV and streaming live every day, 6 p.m. New York time on Twitter. That's all for now from San Francisco. This is Bloomberg.
studios in New York City, this is Charlie Rose.
We begin this week with politics. With just 24 days until the election, Donald Trump has sent the Republican Party into crisis mode. The Republican nominee's demeaning comments about women and allegations that he did more than just talk have upended the presidential race. Joining me now from Washington is John Dickerson. He is the anchor of Face the Nation and political director of CBS News.